Hello, 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 and welcome to 5 Year Club video number 347. Yay! Alright. It has been a crazy week, or just a terrible week for equity investors. No doubt. I've talked about it a little bit this week. We'll talk about it a little bit more today, or tonight rather. Tonight, the main star of the show is this article from September 18th, 2018. Siegel versus Shiller, is the market overvalued? And September, when this article was written, was a very nice time for the market relatively. All of the tragedy and suffering of October and November and December had not yet happened. And so it's interesting to see what these two experts think. I respect both of them quite a bit. Kind of during the good times. It was also interesting. I was watching a Dave Ramsey video the other day. I think it was from January 2018. And he was saying, now is the time to sell your home if you're ever going to sell the home. The market is super hot. If you're going to sell a home, sell it now. And in my own market, what I've observed is like he was right. Housing prices have actually dropped a little bit since then, and I don't think that they're coming back, at least not in the short term, especially because the Fed is raising rates. They're not steady. The Fed is actually like actively like pushing rates higher and higher, which makes the house payment higher and higher for the same price of house. And therefore, if consumers can only pay so much for a property because wages are staying about the same, then the prices of those properties have to come down to meet the possible payments, since most of these homes are bought on credit with a mortgage. Right, but I should say, tonight is brought to you by Rosé Wine. Rosé Wine. I'm hella fancy. Rosé Wine. I just wanted to talk a little bit about my experience kind of going through this, my mindset about it, and much of this stuff I've discussed before. My hope in talking about it in this video is that for people who aren't familiar with it or don't have a lot of investments right now, my hope is that you can see that if you focus on the right things, if you focus on increasing savings rate, if you focus on decreasing expenses, if you focus on having an emergency fund, if you focus on having a rewarding, viable career path, then a lot of the risk and a lot of the trauma associated with severe downturns goes away. And severe downturns are a normal part of the American economy. All right, so headlines. The Dow finished its worst week since the financial crisis. 4 experts weigh in on the fallout. And I think there was something like it's the worst month since 1931 or something like that. I forgot where that article was, but I think that was the most sensationalist one I've seen so far. Dow's worst week since 2008 financial crisis. NASDAQ closes in bear market. And the NASDAQ, if you don't know, is a more kind of technology and I think finance focused index. And so it tends to be more volatile than the S&P 500. Wall Street stocks suffer worst week in a decade. Wall Street suffers worst week in a decade. NASDAQ confirms bear market as worst as economic worries mount. That deserves some wine. All right. And it hasn't been great for me. All right. Like, obviously, like, I look at my kind of investments two different ways, right? I look at it from what net worth do I need to be at where I'm financially independent. So that's just like how many dollars, when you add everything up, are there. So that's net worth. That's gone down, which means I'm now further from financial independence than I was 90 days ago, despite the fact that I've saved most of my income. So that's a bummer. It is expected. Like, if you study the stock market enough, you will see that you will not be able to outsave the volatility of the stock market in certain cases. Like, the stock market will eventually suffer a drop that is so fast that if you have saved any substantial amount of money, you will not be able to keep up with it by saving, say half your paycheck. Like, the market's going to drop faster than you can deposit the money. And so I'm not completely like destroyed and disturbed by the fact that I'm further away. I guess I'm a little bit more excited because now any equities that I buy will be a much better deal than the equities that I bought certainly this year when the stock market was higher. I've lost less than I could have. So what you see here is a comparison of my investment holdings, not their absolute value, but just like how this portfolio would have done if you held a fixed amount of money in it, compared with the S&P 500 over the last 90 days. And I think my drop is like a little bit more than 10%. It's like 11 point something. Yeah, 11.96%. So basically minus 12%. That's where I'm at over the last 90 days. But the S&P 500 is at minus 17.5% over 3 months, which is a big drop if you didn't know. And, specifically more recently, and you can see it from the chart, it's been worse in the last week or two than it was during November or during October, which suggests to many people that the losses are accelerating, right? It's suggesting to many people that this 17.5% drop is the first 17.5%, and we've still got 23% to go. Here I am comparing, the S&P 500, which is the yellow line, and the blue line, which is my mix of investments, which is the S&P 500, but also some international funds, more international funds, and a good number of bonds, because I've been purchasing bonds since like November or so in anticipation of a job change. And that's, I'm comparing that to VTI down here. So that's Vanguard's total market index. And you can see that they basically, they trace each other. It's not perfect, right? But the S&P 500 represents a substantial percentage of VTI. VTI is something like 3,000 stocks. Obviously, it's not 500. However, the top 500 stocks account for most of the weight. And so their movement is going to be very similar to the movement of the total market index. And here we can see it's like ending at 123. It's starting at 130. Wait, no, what is this? It's starting somewhere around 150. I haven't calculated what that loss is, but it's going to be something near 17.5%, give or take 2%. I don't know. All right. So, and then finally, even though I'm losing less money than the S&P 500 in the near term, in the 90-day term, if you look at the performance of my investments for the year of 2008, you can see that I underperformed the S&P 500 for most of the year, and it's only now that things are dropping that my bond portfolio is saving me from tanking as fast as the equity market is tanking. And so now I've kind of reached a break-even point with the S&P 500. So I can say, like, I don't regret my investment choices, I guess, because now that the market is tanking, the cash and the bonds that I hold, they are saving me some. But I'm faced with a choice now, right? And the choice is, do I anticipate a 23% additional drop, and do I change my retirement portfolio to be a mix with more bonds? Or Do I just keep it as equities? And if it drops another 23%, that's fine. I'll just buy more of those cheaper equities, still at 100%, and wait till it comes back. Or do I just go ahead and buy more equities now because I don't think it's going to drop 23 more percent? I think that 17.5 actually puts it at a value where it's attractive. I'm not saying I do. I'm saying that that's one of the options. And I'd like to pause here and just point something out to you. And that is, let's say that I purchase more bonds in my retirement portfolio. So right now my retirement portfolio is 100% equity. Let's say that I want to switch to a 50-50 mix. So I sell 50% of the equities, I buy 50% bonds. All right. Now my retirement portfolio is going to be less volatile. If there are losses, then I will not move down as much. But similarly, if there are gains, then I will not move up as much. It means that if I'm buying more retirement stuff and I'm maintaining that 50% mix, it means every time I buy new retirement assets, I'm buying 50% bonds, I'm buying 50% stocks. Necessarily, that means that when the market comes back, I will likely still be holding a 50-50 mix. And I will have spent 50% of the money that I invested on bonds during that period. And those bonds are not going to come back up the same way the stocks come back up, because they're not going to have the backing of the dividends. The bonds are a debt asset, and they're not economically productive in the way that the companies are that the equities represent. And so I'm going to make less money when the market rises again. And since I'm not able to predict the bottom, there is a risk both in keeping my portfolio at 100% equities and in purchasing, more bonds. So it's not that one is better than the other, right? Like historically, I guess we'll be able to look behind us and say that one is better than the other, but it's just different types of risk depending upon which one you choose. All right, so addressing the question of the value of the equities right now, we're going to look at the Cape-Shiller PE ratio. That is the price to earnings ratio of the, I guess it's the S&P 500. And we can see that, during manias, that ratio, and this is the earnings over the prior 10 years, so it's smoothed. We can see that during the manias leading up to crashes, the Shiller PE ratio rises to something higher than 30, right? So here we've got Black Tuesday right before the big Great Depression crash, and later on we have up to 44, before the year 2000 tech crash. And we were all the way up to, 33. And now it's fallen quite a bit, you can see. We're down to 26. And the question is, should I buy back in? Well, there's several data points to look at. Number one is down here, the mean and the median. We got 16.5 and 15.6, right? So you could say, well, on average, I'm not likely to do much better than the mean or the median, especially in more recent years, where, since 1990, we've touched 15 twice, right? So the vast majority of time after 1990, the stock market has not been at its mean or median valuation according to the last 100 or so years of history. And therefore, I shouldn't wait until it reaches 15 or 16 because it's just not likely statistically. You could also say that more recently there's kind of an upward trend in this PE ratio. And so even if the long-term mean and median is 15.5 or 16.5, you could argue that the upward trend means that kind of an adjusted mean or median is something higher, right? Something more like 19, you know. Yeah, so right now it's at 26. Do I believe that 26 is a great value? I do not. I think that it will probably fall back down again. I do believe, however, that it will not fall much below 15. I think that investors said in 2008, 2009, once it reached 15, they said, well, this is the historical average. It's going to be a good deal if we buy it, so let's just buy it. They got back into the market, and the market came back. And so certainly if it hit 15, I would just I'd go all in, you know, because even if it drops to 10 from there, I still have good evidence that in the long run, that's going to give me 15 is going to give me an adequate return in terms of accomplishing my goals. And if it drops to, you know, something like 10, then I can continue buying with my existing cash flow. 26 though, it still feels high. It still feels like that there is some panic ahead of us, and there is some more trauma ahead of us, and so I should not buy. There's a logic that says if you would not buy the thing, you should sell it, and I guess by that logic, I should be selling out of equities. But at the same time, to complicate things, people are saying that the bond market is even more overvalued than the stock market. And the bond market, additionally, is not, it doesn't move with inflation the same as the stock market. And so you suffer more inflation risk if you hold bonds. And so that complicates the decision, right? Because if you say, you know, I don't think that these equities are good value, so I'm going to sell them, what are you going to hold? And what are its risks? And what are its characteristics? And, you know, me personally, I don't have a good, I don't have a clear vision of that in my mind. The research indicates, or at least the reading that I've done indicates that like stocks in the long run are going to serve me well. A lot of the other assets seem a lot more complicated and unknown. So that's where I'm at, and that's why I chose this article tonight. Two really smart people discussing their thoughts on the market, and it's also interesting because they're discussing it kind of during a peak. I really kind of wonder if I've read this article before on this channel. Some percentage of my brain thinks that I have, but because I don't remember it, I'm like, well, even if I did, it's probably worth reading again. So Siegel versus Shiller, is the stock market overvalued? September 18th, 2018. That's a week after September 11th. More rosé. And I guess going back to my situation, my expenses have been cut so low and my emergency fund is so high, and the effort that I put into my work is so high that I am not worried about a fall in these equities. I'm more excited that I'll be able to purchase more. This is not at all the attitude and the thinking that I had back after I graduated in 2007 and 2008 and 2009 hit. When 2008 and 2009 hit, I had very few invested assets. I was very worried about keeping a job, and it was a lot scarier. But since I've sacrificed so much spending over the last 5 years, now things are a lot less scary. And so it's really a blessing not to have that fear in my life. All right, to the article. In August, the current bull market in U.S. stocks became the longest one in history, and there are scant signs of it slowing down. The Dow, S&P 500, and NASDAQ have recently set all-time highs despite uncertainty over the trade war with China and political turmoil in the White House. For investors and other market participants, the big question is this: Is the stock market overvalued and a bear market is long overdue? Turns out that was probably true. Or are stocks still reasonably priced and more upside is yet to come? You know, people are just unfailingly optimistic because they don't want to believe the first one. To answer that question, Wharton finance professor Jeremy Siegel and Yale University economics professor Robert Shiller made their cases at the recent conference, Financial Markets, Volatility, and Crises, a decade later. Held in New York by Wharton's Jacobs Levy Equity Management Center for Quantitative Financial Research. Siegel is often seen as a perennial bull and Shiller is viewed as ever the bear. The two, who have been friends since the late 1960s, often give opposing market outlook views separately on business television. It is rare for them to spar in person. Siegel and Shiller met while graduate students at MIT. I met Jeremy standing in line for a chest x-ray. They sent us in alphabetical order, Shiller and Siegel, said Shiller, who is a Nobel laureate and creator of the widely followed CAPE, cyclically adjusted price-to-earnings ratio, also known as the Shiller PE ratio. Our books tend to be adjacent to each other in bookstores. What he learned from Siegel was that it's possible to view economics as really connected to the real world. Shiller pointed out that despite how Wall Street and news outlets typically characterize them, it is not true that Siegel is always bullish and that Shiller is perpetually bearish. In 2000, we were both bears, he said. Siegel agreed. Certainly, we've had our disagreements on outlook, but as you said, we were both very bearish at the top of the dot-com bubble in 2000. Siegel is the author of the classic Stocks for the Long Run, often described as one of the best investment books of all time, and I agree with that. So go read it if you haven't read it. Siegel's bull case. Siegel said that since the early 1800s, stocks have brought in a total return after inflation of 6.7% on average annually. And guys, realize this is after inflation. So if we say inflation is 3%, that means that these things are returning 9.7%, close to 10%. I mean, if you put that in the compounding calculator, that is great. Tony the Tiger, great. On average annually, far outpacing other asset classes. Bonds came in at 3.5%, and remember, this is compounding. So there is a huge difference between 3.5% and 6.7%. If you invest at 3.5% for 30 years versus 6.7%, you don't get half. You get like 1/10 or something crazy. So this difference is very, very meaningful. Treasury bills at 2.6% and gold at 0.5%, while the dollar has actually depreciated by minus 1.4% on average yearly. That means $1 invested in stocks over that time would have turned into 1.4 million, while the same dollar in bonds would have become $15.99. But keep in mind that this is since the early 1800s. So it's a longer time period than the 30 years that I was discussing. And T-bills would have been worth $263. Gold clocks in at $3.09. Holding on to that $1 means its value would have fallen to 4.8 cents. In recessions, you get big write-downs. Siegel then examined the stock market's valuation over time from 1954 to 2018. The median price-to-earnings, or PE ratio, a popular metric in valuing stocks, is 17. There was a dip in PE in the 1970s and 1980s when double-digit interest rates brought the stock market down. The lowest point was in March 1980 when the PE hit 7.15. The high over this period was in June 1999 when the PE hit 30 during the peak of the dot-com bubble. Where are we today? You can see we're not that high based on the last 12 months of earnings, Siegel said. We're actually just in the low 20s there. When calculated using this year's earnings estimate, the PE drops to 18 and further dips to 16 when using the 2009 estimated profits based on the type of earnings he uses. Siegel prefers to use S&P 500 operating earnings to get his PE ratio. This calculation includes such things as stock options expenses, pension value changes, and others. Siegel doesn't use the other two types of earnings calculations, which are firm-reported earnings and GAAP, generally accepted accounting principles. Firm-reported earnings are the most liberal, Siegel said, meaning it makes the company's performance look its best by excluding many things from the profit calculation, such as severance costs, litigation expenses, and others. GAAP can be misleading. In the 1990s, GAAP went to mark-to-market. It mandates write-downs and asset impairments whether the asset is sold or not, he said. That never used to happen, and on the flip side, it doesn't permit you to write up the asset until you sell it and prove that there's actually value. So it's almost a one-way buy, Siegel added. In recessions, you get big write-downs. He noted that billionaire Warren Buffett, chairman of Berkshire Hathaway, called GAAP's mark-to-market rules useless when used to analyze the ongoing valuation of a company. Siegel said that over the last 140 years, the long-term PE ratio averaged around 15, which corresponds to a 6.7% earnings yield, or real return on stocks. He said a PE ratio of 18 forecasts a real return of 5.5% for stocks, a 2% dividend, 3.5% real earnings per share growth, with 2.5% due to stock buybacks and 1% organic growth. Nominal return is 7.5%, including 2% inflation. This 5.5% return forecast is more than 4.5 percentage points over the 10-year Treasury note, which is the equity risk premium. The risk premium is the extra returns stocks have to bring to make them worth holding since they are more risky than government treasuries. This premium historically averaged 3 to 3.5 percentage points. The upshot is that stocks are overvalued on a long-term basis, but bonds are enormously overvalued on a long-term basis, Siegel said. The relative valuation of stocks relative to bonds is actually among the more favorable in history, right? So what Siegel is saying is basically, like Lewis, if you hold these bonds, they're even more overvalued than the stocks. And so in the long run, it's not going to work out. And I agree with him. I don't want to hold as large a percentage of bonds in my portfolio as I do right now. But it's very tempting when there's uncertainty in your future. And it's also very tempting when, these dramatic falls happen over the course of, say, 18 months, not over the course of 5 years typically. It could happen over 5 years, but human emotion usually causes it to fall much faster. And if you think you're going to know the answer in 6 months, it's very tempting to just hold the bonds for another 6 months. Now, if you find yourself holding them for it's like the third year you're holding these bonds, you're like, this is not working out. I need to find something to invest in. That may not be equities. It could be real estate, but it's got to be something with a decent return. All right, blah, blah, blah. According to Siegel, the reason why Shiller's CAPE ratio is more pessimistic is that it assumes there will be reversion to the norm, meaning the market goes high and low, but usually reverts to its historical trend. But he questioned this assumption. Should we go back to 15 as the long-run normal, or CAPE at 16.5 or so? My feeling is no, we shouldn't. I say that the warranted PE ratio is higher than history. And one of the reasons for that is indexing at zero cost, which was totally unavailable during the greatest part of this market sample. So in other words, he's saying that basically index funds are so convenient that more people are going to buy them, and it's easier to buy them. And so we're just not going to get the same value that we got before out of stocks. If indexing is cheaper, then does that remove risk? And removing risk gives lower returns? I don't know. I need to understand this better than I do right now. Siegel said that for much of the stock market's history, the average investor had to pay higher brokerage costs, bigger bid-ask spreads, etc. I don't think it's unreasonable to assume 1% to 1.5% per year in transaction costs back then to do it. Now it's zero with ETFs and the like, he noted. What does this mean? Will you really get 6.7% in the 19th and early 20th century? No, at best you're probably getting 5% real, which actually corresponds to a 20 PE ratio. 5.5% real would correspond to 18. The market is filled with real people, and they have their own stories they're telling and ideas that change from time to time. So, should we think like it's 1916 or not? Siegel continued, so given that costs have gone to zero of maintaining a fully diversified, efficient portfolio, that in and of itself argues, in my opinion, for a higher equilibrium PE ratio than historical. You could almost call that a new normal of zero transaction costs. By the way, I'm not even talking about interest rates being at record lows, which could maybe inflate the ratio. Moreover, for every 1 percentage point drop in dividend yield, there should be a corresponding increase in EPS growth, that's earnings per share growth. That leads to a distortion in Bob's CAPE because Bob assumes a constant real growth if there's going to be a lower dividend yield. Bob actually moved to a total return CAPE, which is different from the CAPE published on his website that makes the correction. Shiller's bear case. Shiller presented a chart showing the S&P Composite Index juxtaposed against the EPS earnings per share trend line going back to 1871, adjusted for before the S&P 500, the S&P was created. Siegel and I agree that history is important. Why is history important? It's because big movements in these ratios don't happen very often, he said. You want to understand what they mean. Between 1910 and 1930, there was a big jump in earnings around the time of World War I. That spike occurred before the U.S. ended the war. You notice the stock market didn't go up very much. Why didn't it? Newspapers called it the flood of earnings, and they attributed it to the war. A lot of Europeans were buying munition supplies from the United States. Why didn't the market go up? The earnings leap was due to the war. It was not permanent. After the war was over, the earnings went back down, Shiller said. I think the market did the right thing in 1916, which is not to overreact to the sudden burst in earnings. Then Shiller noted that earnings jumped again between 1921 and 1929, but this time the market went up all the way. The peak in 1929 was an overreaction. They didn't have the skepticism that they had in 1916. Why didn't they? It was a different atmosphere. It was the Roaring '20s. They just wanted to believe it. Of course, the Great Depression came shortly after the market crashed. Shiller gave another example. In the 1980s, earnings were going up, but stocks were not. What was the spirit of the time in the 1980s? Double-digit inflation and really high interest rates, he said. But then in the 1990s, both earnings and stock prices shot up. Also, leading up to the 2009 crisis, earnings were rising, but stock prices didn't go up as much. Now it's doing it again, with stocks and earnings rising in tandem, Shiller said. If you want to predict tomorrow's price change, it's very hard, but if you want to predict what's going to happen in 5 to 10 years, you have a better chance. This is just the reverse of weather forecasting. The market is filled with real people, and they have their own stories they're telling and ideas that change from time to time, Shiller said. So, should we think like it's 1916 or not? Is this temporary? Well, it's kind of fuzzy. Probably the reason earnings are up is because they've cut corporate profits taxes, and pro-business Donald Trump is president. So is Donald Trump permanent? I won't get into that. He added that he thinks the market is overreacting again. We're launching a trade war, Shiller said. It's likely to be a bad time for the stock market. Shiller said the CAPE ratio is calculated by taking the inflation-adjusted index price and dividing it by the 10-year average of inflation-adjusted earnings to smooth out business cycle fluctuations. So this is what I described before. It is commonly used to determine whether the stock market is overpriced or not from 1926 to mid-2017, when the CAPE ratio hit an average low of 8.6%. The stock market returned a very high 9.8% average annual real return for the S&P 500, he said. When the CAPE ratio is at 33, the average return is less than 1%. That's where we are now, Shiller said, hastening to add that he's not predicting a crash. This is a 10-year forward return. If you want to predict tomorrow's price change, it's very hard. But if you want to predict what's going to happen in 5 to 10 years, you have a better chance. This is just the reverse of weather forecasting. However, Shiller remains convinced that the stock valuations are just too high at the present day. Even if one uses other metrics to substitute for earnings, such as book value, cash flow, and others, he noted, the outcome is the same. Shiller said Siegel has been a strong critic of CAPE because it uses firm reported earnings. Shiller did acknowledge that changes in accounting rules over time may have led to a downward bias in reported earnings, resulting in an upward bias in CAPE. So Shiller and one of his colleagues replicated Siegel's results using total return CAPE. They still forecast that expected returns should be lower for the next 6 to 10 years based on historical trends. Moreover, Shiller said Siegel's earnings data are not squeaky clean. He pointed to a footnote in a 2016 Siegel paper disclosing that this NIPA, National Income and Product Account, per share profit series is then spliced to the S&P 500 reported earnings series by equating the 10-year averages for 1929 to 1939 for both series. For his part, Shiller said that instead of using econometric techniques to splice two different histories together, he and his colleague re-evaluated Siegel's results using actual reported observations. The result is a 25% lower 10-year annualized total return. Finally, Shiller said Siegel's argument that modern times call for a re-evaluation of the market sounds similar to one made by economist Irving Fisher in 1930 in a book called The Stock Market Crash and After, which was very optimistic about the stock market. Fisher said that now in modern times, investors are much more sophisticated, and they know that the stock market has outperformed other assets over the long run. They know they can diversify their portfolios, and they even have funds that would help them do that. He predicted a brilliant future for the stock market in 1930. It was a short-run mistake. The equity premium right now is high on a historical basis. Let's see, the equity premium right now is high on a historical basis. Let's see. I guess this is a future quote from this article. So, historical, yes, it's going to be found below there. I just wanted to make sure I hadn't already read it because I didn't remember him saying that yet. Shiller believes that the spirit of the times informs the market. Back in 1929, there was a sense of glamour or opportunity with a big housing boom and a roaring stock market just before the economy turned south. Right now, we have high real estate prices and high stock prices happening at the same time, Shiller further pondered. What is the zeitgeist today? What is the atmosphere? It's a time in history when we not only have Donald Trump in the U.S., but we have populist leaders around the world, and they are kind of nationalist. It's also not a friendly time. Tech stock trends. Siegel responded to Shiller's comparing him to Fisher by pointing out that the average cost of mutual funds in Irving Fisher's day, even up to the 1960s and 1970s, was 2% a year. You are definitely lagging that amount in portfolio returns. Today, you don't lag. He also pointed out that economists today have a hard time explaining the risk premium. The equity premium right now is high on a historical basis, Siegel said. 10-year TIPS, Treasury inflation-protected securities, are under 1%, and yet stocks are 5.5% at current valuation. That's a big margin. Margins should be smaller. As for real estate prices going up, Siegel said it's because of older investors seeking a higher investment return. We have an aging investor class. Real rates of return are very low. Growth is low. population growth is low, and risk aversion is a bit higher after 2 big bear markets in the last 15 years. That's one reason you have a higher equity risk premium. But real interest rates are low and likely to stay low for quite a while. That would cause real estate prices to rise. Siegel also pointed out that globally, U.S. real estate is considered cheap. Other countries have gone up much more. I'm not saying that's rational. I'm saying it's not a local bubble. Asked how the current hot FANG stocks, Facebook, Apple, Amazon, Netflix, and Google, would fare in the long run, Siegel compared the situation to the 1990s, when small stocks were believed to outperform in the long term. After further investigation, he found that the small stock premiums from 1929 to the 1990s were mainly due to a 9-year period starting in 1975 of unbelievable outperformance. The rest of time, they did not. Here was something that was supposed to be a persistent outperformer, but it only showed up for less than a decade and then tended to disappear, Siegel continued. Is that what's happening now? We have the FANG outperformance. Is this a new paradigm, or is this just a streak that is going to come to an end? Now, no one knows this for sure, but I did want to mention that other stocks have shown a lot of correlation with FANG and streakiness that subsequently disappeared. So he thinks the tech markets may be just a temporary streak. So there you have it. There you have it. They said that it was overvalued, more or less. In September, they had a little different opinion on it being overvalued. Clearly, at least based on the evidence now, Shiller was on the right side of this argument. And I don't know. When I read it, it's almost like they're trying to come up with reasons why things won't go bad. And they're kind of nerd sniping about, which type of earnings are you using in your report? And, it's interesting, fair enough. But yeah, there we go. Does this give us any solution? Does it give us any answer? I don't think so. Just the same answer that I always have, which is save that money. Save some money. And that way you'll have the money to pay for things in the case the market is too high, or to buy equities. I'm putting my microphone away. That's why it's over here. When the market is low, or buy equities when the market is high, or just buy equities all the time for that matter, because they outperform. All right, that is it for video number 347. Hope you enjoyed it. Have a fabulous evening.